Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's February 21st, 2023, a beautiful Tuesday morning down here in South Florida. We got a big show coming up for you today. We're going to talk about the markets, a bit of a pullback in the last week, what this means long term. Also, we're going to look into the factory of the future and how we can make money on that. All this more coming up right now on Making Money. One of the most successful entrepreneurs in America over the past 50 years is going public with his fourth and final prediction about a scenario he calls America's Nightmare Winter. You've probably never heard of Bill Bonner, but in addition to owning an interest in businesses all over the globe, he also owns more than 100,000 acres with massive properties in South America, Central America, the US, plus 3 large properties in Europe. Bonner says, we're about to enter a very strange period in America, which could result in the most difficult times we've seen in many, many years. Bonner has made 3 similar predictions in his 50-plus year career, and each one proved to be exactly right, although he was mocked each and every time. That is why I strongly encourage you to read about Bonner's fourth and final prediction, totally free today. It's all spelled out in a free report we've put together about America's Nightmare Winter scenario. Get the facts for yourself. Go to www.americawarning2023.com. Get your free copy of this report. Even if he's only partially right, it will dramatically affect you and your money. So again, go to americawarning2023.com for this free report. As I mentioned, it is an absolutely beautiful Tuesday morning. Looking out here right now, the ocean's rocking, the sun's shining, the heat's blaring. I got to put my sunscreen on and get out there, get some vitamin D in a bit. But first, we got to take a look at these markets. With the market pulling back again, the kickoff the week after a long weekend, a President's Day weekend. And we have the S&P, we have the NASDAQ, the Dow, all down a bit here, early trading. And I don't want to give a reason why we're down one day, but if you read the headlines and what's going on lately, it's coinciding, this pullback's coinciding with interest rates moving up a bit. And we'll take a look at that in a minute. But as interest rates have been going up, there's a fear that inflation's still hotter than it should be. There's a fear that the Fed will then be more aggressive than it should be. And that will lead to stocks, pulling back from the rally that we've had so far this year. So it makes sense as to why we're seeing stocks pull back a bit. I don't want to read into it too much. And again, I'll show you the chart here in a moment. I don't want to read into it too much because we had one hell of a start to the year and we can't go straight up. Even though we had a rough year in 2022, we're going to have, ebbs and flows. We're going to have some rallies, we're going to have some pullbacks, and that's okay. So let's dive in right now and take a look at the S&P 500 on the chart. As you can see here, this is the same chart I show you every week. It just obviously gets updated with the newer action since last week. The white line's still there. That was a downtrend line that was broken. Remain above that. Remain above the red line, which is the 50-day moving average. Remain above the blue line, which is a 200-day moving average. That being said, we're down about 3.5% to 4% from the intraday high that we set on the first trading day of February, which at that point was the best level that we've had in about 5 months. Again, 4% pullback. But keep in mind, folks, I could draw another beautiful white line connecting the lows in October through the pullback in December to where we are today, and we're still above that, the new uptrend. And I'll put that in next time for you because we have started really a new uptrend in the last 4 or 5 months. And again, pullbacks are okay. Pullbacks can be healthy. We're not seeing a large amount of volume coming in on the downside. We're not seeing kind of a breakdown on other charts. We're seeing a lot of stocks still remain above their breakout levels. We're seeing other indices above their breakout levels. So if anything right now, I'm looking at my watch list, which I'll share a couple stocks from there later that I'm looking at, to look to enter on this pullback. Because I believe I wholeheartedly that 2023 is going to be a great year. We're going to have a lot of rallies and a lot of pullbacks along the way. It's going to be volatile, I'll tell you that. But I think we're going to have a really good year. So let's take a look real quick at interest rates because this is important. And as you can see here, we're looking at the 10-year yield. And at the same time that the market hit that high the first day of February, as you can see here, the first day of February in the 10-year yield, we hit a multi-month low. Since then, we've been rallying. At the same time, the market's pulling back. There's a direct correlation between these two. With the 10-year back to 3.92% right now. We came down about 3.3 and change. We hit the high around 4.2 back in October, which is when the market bottomed. So again, there's a direct inverse correlation, I should say, not correlation, direct inverse correlation between the 10-year yield and the stock market right now. So if you want to get some type of indication where you believe the market's going, I would look at the yields right now because, again, but that's driven, though, by fear, speculation of what the Fed's going to do if they're going to be more aggressive. The next meeting will be the middle of March, so about 2-3 weeks away, give or take. And we'll get much more insight into what the Fed's thinking, not only about what they do with interest rate. The odds are for a 25 basis point hike, 0.25%. It's going to be more about what they talk about in the future because there are indications that that will be the last rate hike in this cycle. There's some people who believe the Fed actually might do 50 in March, and that would lead to a big sell-off in stocks, in my opinion. I believe the Fed should do 25 basis points in March. I believe they will do 25 basis points in March. Where we differ is I believe they should stop right there because inflation is coming down and it will continue to come down. You don't shoot up to 40-year highs in inflation and get right back down in 2 or 3 months. It takes time. The trend is lower. There's no argument about that. The trend is down and it's getting better. So the Fed has to be patient. But because they effed up so many times over the last couple of years, you start overthinking things. And that's what's happening. The Fed's making a huge mistake here if they go 50 this meeting or if they go more than 25 after this meeting. They're gonna risk putting this economy into a real recession if they keep doing that. Because it's gonna have a real trickle-down effect on the market and on the economy. Maybe they don't give a shit. I don't know. But they're trying to make up for errors that they made by making potentially another bigger error. Own the error that you made and do the right thing now. We'll see if they do. I mean, we're all human, right? We all have egos. And if you're a Federal Reserve chairman or on a Federal Reserve board, you probably have one hell of an ego. You're probably half a narcissist, if not a full narcissist. So you want to look good. You don't care as much about really the market or anything that's going on. You want to make sure that you did the right thing. I beat inflation. Well, we wouldn't have had inflation like this if you didn't mess up in the first place. Think about that. All right. On a brighter note, my rant's out of the way. On a much brighter note, I had a show kind of mapped out for you. I was going to go through my deep watch list that I went through. 3-day weekends, I love and I hate. I hate it because the market's open one less day, and I love when the market's open. I love it because it means an extra day to do some reading, do some research. So Monday, yesterday, I actually worked a lot of it and spent a lot of time looking at my charts, going through new ideas, and came up with quite a few. But then as I was about to sit down and do the show, something popped up. I have a little piece of paper here with different symbols and notes I take throughout the day. And I saw something I scratched on there. I scratched it on maybe, I don't know, a couple of weeks ago. And I wasn't quite sure what it said because it's my handwriting's really bad. And it said MAKX. I'm like, what the hell is that? So I typed it in. And I remembered that I wanted to do a deep research onto this ETF. So this ETF is called the ProShares S&P Kenosha Smart Factories ETF. The symbol is MAKX. Let me show you the chart here real quick. It's a very small ETF. It doesn't trade much at all. I'm not recommending you go out and buy this ETF by any means. I'm not a big fan of ETFs. That being said, what I wanted to show you here was, you see that rallied up in August. It rallied up again in December. Then we broke through there in late January and we're consolidating. Very nice, what they call kind of a W, double bottom breakout. On a technical basis, this is very, very strong. So we'll get back to a couple of charts in a minute. But the reason I want to bring this up is I looked at this, and a lot of the research I did over the weekend had to do with some kind of groundbreaking technologies. One of them being really the factory of the future, if you will. I always think about factories growing up in Bethlehem, Pennsylvania. I think of the steel company, Bethlehem Steel Company. And a lot of those structures are still there. I've done a speech there a couple of years ago with the steel stacks behind me. It was really kind of neat coming home and seeing that. But a lot of my family worked at the Bethlehem Steel, and I just think dirty old factories. I mean, a big reason the Bethlehem Steel went out of business, I mean, it's really two. Japanese steel is one. Another one is the fact that they refused to kind of move forward with technology and innovation as the Japanese did, and they put them out of business. And that was a big hit to the area, to the Lehigh Valley in Pennsylvania. It was a very big hit because a lot of people, as mentioned, a lot of my family, my father was laid off due to that. A lot of people lost their jobs, friends and family that I knew. It hurt. But they lacked that innovation at the Bethlehem Steel. You're seeing a lot of factories now in industry moving forward and innovating. And I think about it now, the Bethlehem Steel, I just think like dirty, and just kind of outdated. There's a lot of factories that are still like that. The factory of the future, to me, and it's more of a almost like a white clean room. It's very all white clean room that you picture in like a biotech, and that really will be what it's like. It's going to be all automated. It's going to be clean. It's not going to be what you picture in the old factory. So I looked at this ETF this morning before I jumped on into the show, and there's a couple of stocks in that really jumped out at me. So I wanted to go through a couple of these ideas, and I will tell you, folks. People ask me all the time, how do you come up with these ideas? Number one, I read a lot. I read a ton, not just books, but other newsletter writers, different publications, a lot of research reports, and come up with ideas that way. And books about the future, because I think that's fascinating, how different people see the future in very different ways. And of course, the past. You have to read about history as well, because history, regardless of what people say, it does repeat itself. Not the exact same, but history does repeat itself. So you want to know about that. One very simple way that I came up with coming up with new ideas way back in the day when I used to manage money is you look at an ETF that's doing very strong. A lot of times I do these scans and look at the strongest ETFs. And then you break it down from there and you see what the holdings are. Because that ETF is only strong because of the holdings it makes up. And so I looked at the holdings here of the Smart Factories ETF. Again, the symbol is MAKX. And I looked at it, I'm like, there's a lot of great stocks in here. So I thought, let's take a look at some of these companies because you can always come up with some ideas this way. So we're going to take a look at the top holding right now. And this is Rockwell Automation. The symbol is ROK. And Rockwell Automation is a fairly large company. It's about $33.5 billion company. It's held up well. I'll show you a chart here in a moment. But it's spun off from Rockwell International. And it is a pure play automation play. And I love automation. I think, when you think about the factory of the future, it's about automation. Back in the 20s, when Ford went with the assembly line, how that changed things. I don't think this is going to change it to the same extent that the assembly line changed the world. But I do believe that automation really will increase production. At the same time, a lot of companies looking for people to work, and they can't find it. They'll be replaced by this. And again, I'm not against people being out of jobs, but if they can't find people to work and pull a lever, they're going to automate it. And we're already seeing that. You go really anywhere. I mean, this isn't a factory, but what airport was I in this weekend? I was in Chicago, O'Hare. I stopped through O'Hare this weekend. And they had a little like Amazon store there where you walk in, you walk out. You don't do anything. It automatically pays. It was a really small store. It's kind of neat. I didn't go in because I didn't need anything, but I looked at it. But again, automation, this is the future. So Rockwell Automation, $33.5 billion company. Sales last year, about $7.76 billion. Looking for about 8.6 this year, up to 9.6 2 years from now. So it's got some decent growth for a large company. Take a look at the bottom line. They reported last year $9.49 a share. This year, looking for $11.25. That's big growth, up to $13.50 in 2 years from now. So it's got a forward P ratio of 23, price of sales 3.6. So not cheap, but not expensive at the same time. Has about a 1.6% dividend. Now here's a chart. So what I like about this is we talk about the market, everything bottoming in October. This bottomed back in May, in June, and formed that W bottom. I remember I just talked about that a moment ago. That W, it's very, very strong. And when you break above that W, oftentimes you rallied and you come back and you retest the top of that pattern, which it did around 220, 215, and has been rallying ever since then. So this chart, and I'm going to show you the longer term chart here for a second, still well off the highs that hit in 2021, around $355 a share. We're at 292 right now. But to me, there's still a lot of upside potential here. And just with the future of automation, I think this is a great core holding for the future of automation. And again, nothing here is a buy or sell recommendation. These are just ideas and education. But, you could sense what I like, what I don't like. But again, not telling you to run out and buy anything by any means right now. The second largest holding is a company by the name of PTC. It's about a $15.5 billion company. And they offer high-end computer-assisted design. And they software as well, Internet of Things. They also have some augmented reality industrial solutions. Founded back in 1985, has 28,000 customers. About 45% revenue comes from North America, 40% from Europe, the rest around the world. So it is a truly international company. As I mentioned, about $15.5 billion company, $1.9 billion in sales last year, looking for 2.1 this year, up to 2.65 by 2025. So not huge growth, but decent growth. $4.58 a share last year. Looking for a dip this year down to $4.35, back to $5.13 next year. So a little dip this year coming back. Now let's take a look at the chart, because we can look at the numbers all we want, but the chart has to kind of coincide with it. And this has a great chart, folks. As you can see, it broke out to a high here in January. We've since pulled back right on that support level around 128. You also have the 50-day moving average sitting there. This is a really nice looking chart. If we zoom out a little bit, look longer term, we can see that it also hit a high in 2021, around 155 a share, around 130 right now. I think this can retest that high this year at some point. And that's not a huge upside from here. It's only about $25, about 20% on the upside. There's also a downside. It could come down about 118. I wouldn't be surprised. So about 11 or 12 on the downside, 25 on the upside. It's only about a 2 to 1. Not a screaming, buy out there for me by any means, but one you may want to put it on your watch list, because the chart looks great. And in this market to be breaking out to a yearly high, even though it's pulled back recently, says something. It says that it's definitely got relative strength versus the overall market. I'm going to skip down a little bit to number 7 or 8 holding here. Makes about 4% of the ETF. This is Cognex, CGNX. It's a company I've followed for quite some time. Has not looked good as of late, but it's about an $8 billion company. And it got hit with earnings last week. We'll look at this in a second. So about $8.3 billion company. Did $1 billion in sales last year. Looking to dip this year down to $930 million. Get back to $1 billion next year. So really no growth on the top line. Earnings last year, $1.31. Looking to dip this year down 97 cents, back to 150 next year. So you're seeing a dip, and you're going to see that in the stock chart I'm about to show you here in a minute. As you can see, CGNX, very different looking chart than PTC or even Rockwell Automation. You can see the big dip here last week. That was on earnings. That was Friday. Huge volume. Gap down from 56 down to about 48. We're trading at 48 and change right now. I never touch a stock after bad earnings like that, because it usually takes some time to shake out. This could come all the way back down and test the 42. If I show you the long-term chart here, folks, you can see this topped out in early 2021 above $100 a share. So we're about 52, 53% off an all-time high. So again, even though I like this company, I like what it's doing, it's not a nice time to jump into it right here. So we'll take a look at one more here out of this list, because these are all very important companies when it comes to the future of factories looking out. This is Hollysys, HOLI. And when I show you a chart of this in a second, you'll see it's much different than the last one we looked at. It is a China-based company, so don't get worked up. It's China-based. They do automation, control technologies as well. In the software, they have a rail segment where they have train controls. They have another segment that has subsidiaries that provide mechanical, electrical solutions. It's a Chinese company. Let's be real. It gets majority of its sales from the Chinese domestic market. About a $1.1 billion company. We take a look at the financials here. About $707 million sales last year. Looking for $842 this year, $1 billion next year. So it's going to be the cheapest of the group that we're looking at. And we take a look at earnings expectations. Expectations this year for $1.65. So it's trading at a PE ratio about 11 and change based on this year's potential numbers, based on this year's revenue numbers, 1.16 price of sales. So it's much cheaper than the rest. A lot of that has to do with the fact that it's a Chinese company. Let me show you a chart. This is a nice chart. It's really been in an uptrend since last December. So it's been a year-long uptrend. If I zoom out and look at a bit of a bigger picture, it was going sideways really for about a year, 2020, 2021, and then started taking off. I got to tell you, folks, I know people hate China right now more than ever for some odd, maybe it's the balloon, maybe it's whatever. It's still the world's second largest economy. And you may not want to invest in Chinese companies, but I try to keep the political views out of a lot of my investing because I've learned over the last 20 plus years, if you have political views in it, it's probably going to run you awry. It's not going to be the best decision. You have to look at just purely what the company does, what the trend is, obviously the chart and the fundamentals as well. And to me, Hollysys Systems looks like it could be a winner. So for those of you that are not afraid of China, it's a very risky small cap company. It's only $1.1 billion, but it's one way to look at it. But I will say this. There's a lot more that I like in this area, and I'll do more work on it. But the factory of the future is real. It's here already. But you're going to see a lot of money spent on that in automation, robotics, artificial intelligence, connectivity. Will all be part of this as they all converge and come together for the factory of the future in the next decade plus. So I hope you liked today's show. Hope you got some good ideas from it. Hope you got educated. Hope you had some fun. And of course, at the end of the day, we're looking to make you some money. And hopefully we'll do that over time as well. So far, I did the numbers this year for our two portfolios in our newsletter. They're both crushing the market year to date. We did have a rough 2022. I'm always going to say that. I'm not going to ignore it. But we're having a hell of a start to 2023. And even though we've had a pullback here in the market, I truly believe that this is probably a really nice buying opportunity for investors that are looking long-term to buy into some weakness and some strong stocks on a pullback here after a very strong start to 2023. So again, folks, thank you so much for watching. Hope you have a wonderful Tuesday and Wednesday. Thursday, we'll be back with a great interview. We had a special guest coming up. You'll see that Thursday. But again, thanks so much. Thanks for watching. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.